Well, I'll start with the background because this monetary policy is coming just a week after the interim budget, which had two positive surprises. First, that the government stuck to the path of fiscal consolidation, and second, it lowered its market borrowings for the coming fiscal. On the domestic front, you have growth that seems to be holding up, core inflation which has come to below 4% levels for the first time since early 2020. On the global front as well, the Federal Reserve has indicated there will be no rate cuts at least in March. The US economy also seems to have managed a soft landing. So no big reason really to cut or hike or move, on rates whatsoever. And therefore, the street may well focus on liquidity over rates in this policy. Now, liquidity conditions, as we know, they've persistently remained tight since the last policy in December, with the exception of the last couple of days, of course. So the street is going to watch out for any direction on the liquidity front. How much liquidity is RBI going to provide, and more importantly, how will it provide that? Whether that will be through the variable repo rate route or some other instrument, any action, any direction on this front is going to be key to watch out for. Now, other than that, the MPC is expected to leave rates unchanged for the sixth consecutive time, because there's no real reason to justify a rate cut just now because inflation is closer to the 6% mark than the target 4%. The committee is also expected to maintain the monetary policy stance at withdrawal of accommodation. As per almost all of our respondents, some economists, however, pointed out that there is a very small chance of the stance being shifted to neutral, what with the interbank call rates declining below the repo rates, but that is not the base case scenario. Now, the communication is also likely to turn a little less hawkish because RBI will indicate its comfort with the current growth inflation dynamics. So 90% of our respondents expect the tone to remain absolutely even. Some even are expecting a slightly dovish tone from the governor this time around. Now, other than this, when will the cycle really turn? According to our respondents, the window may not open before the June policy, with half the respondents expecting it in the second quarter of the financial year and 40% in the first quarter of the next financial year. Now, as far as the other macros are concerned, RBI is unlikely to tinker with the inflation estimates for FY24 and even for the next few quarters. But when it comes to the GDP forecast, the majority is expecting the FY24 forecast to be left unchanged at 7%. But remember, the NSO has revised its estimates to around 7.3%. So a third are expecting that perhaps RBI may align with that.